I'm actually very negative about markets this year, generally. From what we see, you're looking at liquidity conditions beginning to tighten.
I think that I probably have less of a contraction of liquidity view than Michael. I don't really believe that we're in a contraction in liquidity, just because I would agree that there are some risks in liquidity right now that are like building. But
Meet Michael Howell, CEO and founder of Cross-Border Capital, a London-based investment and research firm.
With over 40 years in global finance, he's a leading expert on liquidity and capital flows. Before founding Cross-Border, he held senior roles at Salomon Brothers and Baring Securities.
Capital Flows is one of the sharpest minds on FinTwit.
On his excellent Substack, he connects the topics of liquidity, cross-border flows, equity valuations, and crypto assets like no one else.
And so the question is, if you've got limited liquidity expansion in terms of financial money going into financial markets from the Fed or from the private banks, and you've got investors that are pretty full up with risk assets already, where's the marginal buying going to come from?
then we have Japan continue on their fiscal side, where basically every downward movement we've had in the yen has just pushed up Nikkei valuations, and it's also helped push up equity valuations in the US, right? It's been one of the contributing factors for liquidity in the US. The kind of question is like, how much longer is that going to push liquidity into the system?
But I think, the question to ask is,
hey guys, I hope you've been enjoying the episodes I've been putting out as much as I do. For me, it's been a great journey with less noise, more signal, talking to all these experts all the time. With each and every episode, I feel like I have new points to ruminate on, things to ponder over. And yeah, I've just been learning so much. So if it's the same for you, I'd appreciate you subscribing to the show on YouTube, also commenting with the episodes when you have something to say, like it and share with your friends and families and colleagues. That would be much appreciated. And that way we could reach more people with this great content and grow together. So thanks a lot for doing this. Much appreciated. And yeah, let's go. Hey guys, welcome back to Less Noise, More Signal. Today, I'm very, very honored to have two people on the show. It's actually a first for us, sort of a joint episode. And we are joined by no other than Michael Howell and Capital Flows. So it's amazing to have you guys here and to bring you guys together, given you guys are both like very astute thinkers in the space.
well, it's a great honor. Thank you.
Thank you. I'm happy to be here. Looking forward to it.
Yes, great. So I was already telling you just offline before we started, like my sort of idea for this would be to focus in on cross-border capital flows, because that's something I feel like I recently just came around understanding that this is very important. So I'm really a novice here and trying to learn from the best. And my start-off question would sort of be, given that you both have like a Substack with the word capital in it, Capital Flows or Capital Wars or Cross-Border Capital, I think it's the firm called of yours, Michael. So what is the important about cross-border capital flows that fascinates you? And then also, where do you see the relevance for investors? Maybe, Michael, you want to start?
Okay, well, maybe the best way to start is with history. I started off in this business as Salomon Brothers. Salomon's sort of, long dissipated at the history books, but it was the biggest, fixed income trading firm worldwide. It's pretty much the bond markets through the 70s and probably up to the mid 90s worldwide. And the thing about Salomon Brothers is that it basically had large trading floors. I mean, that was really the sort of modus operandi of what it did. And very much the view was that there's no unrelated event in financial markets. But the point about the trading floor was that you had a trading floor really populated with different desks. And those different desks could be a different geographical region or a different product type, equity, fixed income, for example. But you'd actually visually see the movement of money, the movement of capital across the floor. So you'd see one, a little bit like a Mexican wave, if you like. And you could see that movement, in different offices whenever you looked across the trading floor, because it was very much a visual thing. And that's what really made me aware that capital and capital flows and cross-border capital flows are really the critical element. So, that's the history. That's where we started to look at it in detail. And it was very much the case that understanding the movement of this money was very much, gave you lots of insight into how financial markets would move. Basically, although Salomon's had a big research department, I think many people were kind of cynical about what the textbooks would tell you about how markets worked. It was very much about watching money and understanding capital flow, which is really the critical element. So that's really the genesis. And what I'd say, cross-border capital flows are not always the driver of markets, but they're pretty much always the trigger for instability. And that's why they're so important.
Yeah. I feel like that makes a lot of sense. I don't know, capital flows, do you have anything to add? Like, what is your experience? How do you came about thinking about the importance of them?
Yeah, well, I would definitely agree with what, Michael was talking about, because I think that his work, especially in the area, has kind of set a precedent to how to kind of understand a lot of the cross-border flows and liquidity in the system. And I think that, especially from my perspective, when I would look at markets and spend a lot of time running trades and trying to understand my risk, it would a lot of times come down to asking questions and saying, why is this happening over here? Why is this happening over here? Right. And beginning to say these correlations don't occur in a vacuum. And I think, the entire idea that, Michael lays out about all money that's anywhere comes from somewhere. Right. I think if you start with that presupposition, you begin to form a view that's very important for risk taking. And one of the reasons I've kind of had a development of like a flows of capital framework is because when I'm looking at a movement in the market and something changes, I want to understand the drivers why that's changing. Because if I can know why, I can begin to take a view on, is this persistent or is it going to mean revert and begin to go back to whatever previous trend or might have had. So I think that, the flows of capital are very interesting. And when I see a movement in markets, whether it's in equities or rates or FX or something like that, I always know that if something's getting bought somewhere, it's some type of pair trade getting sold against something else, right? And all of those flows of capital, both in the underlying economy and financial markets, they all net out. And I think that, even though I think you have this presupposition that these flows net out, and I think the entire question within that is, okay, since we're still operating under uncertainty, we know that these flows net out, but how exactly do we make informed decisions with foresight in real time for risk? And I think that's why understanding the mechanics is so valuable, because it sets that foundation to have foresight as opposed to just kind of, just taking views on, basic correlations or just price action, as I think a lot of the quants would do. They're just very focused on how do we establish whatever your correlation risk or empirical significance around that. And I think there's just so much value to understand those mechanics that Michael's broken down in his Substack and book and things like that. So I would say that's the way that I approach it.
Yeah, I think that's well said, because if you look at the way that most quants or most textbooks tackle problems, it's very much looking at the micro. And if you like, sort of doing marginal arbitrage trades without looking at the big picture. And so often you see, particularly in crises, that everything tends to correlate together. And that's because of the movement of large waves of money. So that's, and maybe that's exactly why, if you look back over the last 20 years or so, maybe a tad more, CTAs have been so successful as a sort of fund structure, because they're looking at the momentum underlying markets. The markets basically have a lot of momentum, and that's to do with these capital flows.
Yeah, I agree. I think one of the interesting things that's happened over the last, I would say, especially 5 or 6 years, is there used to be, I think, a little bit more lead or lag in the space between equities and rates and FX and all these different flows of capital. And I think that now the sources of liquidity and capital and their destinations are all priced incredibly fast, right? You don't see as much anymore where you have like one asset kind of like leading the way in one session, and then you move into the next session and the entire thing gets priced as if there was like some massive lag or something like that. I think you now have like a lot more efficiency in terms of how you're running kind of these correlations and how they're getting transmitted cross-border on a short time horizon. But I think that's the efficiency that the quants have brought on that micro level have now pushed discretionary risk-taking out on a higher time horizon, which now necessitates understanding some of these flows of capital in a way that, that that liquidity provision, I think in the past, people in a bank or a hedge fund could just trade around because spreads were a lot wider, right? And know less about, I think, the mechanics. And now I think that understanding those like mechanics, especially where we're at with trade and global liquidity and things like that, are becoming even more instrumental kind of in the system.
Imagine lowering your tax bill while stacking Bitcoin. With Blockware, you can. Thanks to new tax guidelines, you can write off 100% of your mining hardware costs in a single year. Blockware's mining as a service takes care of everything, so you can start mining Bitcoin effortlessly. Visit mining.blockwaresolutions.com/LNMS and get $100 off for your first miner. It's a good point, but like my question would sort of be to both of you, given that there is so much importance to these capital flows. And as I said, I'm still a rookie. I only just recently joined the bank on the investment floor. And I've been talking to these people and there it feels like maybe I've been talking to the wrong people, but also on X and on the investment floor that I mentioned, hardly anyone is focused on this macro big picture and let alone these cross-border capital flows. I don't know, Michael, have I been talking to the wrong people or why is this the case?
Because I think the way that finance is taught, at the academic level, is that these factors are not even considered. You won't find cross-border flows, capital flows mentioned in any finance text. It's all sort of intricate math, which really corresponds to this notion that I said right at the beginning, that it's really looking at, if you like, marginal arbitrage, looking at individual securities. The whole of finance is based around the idea that you're looking at a value inherent in an individual security. Whereas if you're looking at markets, you're looking at the actions of large groups of people, and the actions of sort of big institutions like central banks that are moving money. And it's that which tends to influence prices much more. In other words, to look at it in a sort of more wonkish way, textbooks assume you've got a very constant risk premium or return premium, where in actual fact, in reality, we know they move all over the place. And it's that movement of term premium or risk premium, which is really what capital flows are influencing. So I think you've got that backdrop. But I think, the question to ask is, just look back over the current cycle. I mean, the last 5 years. I mean, it may not have been exclusively cross-border flows that have influenced markets, but it's certainly been central banks. But it's been central banks influencing, flows of money, whether it's Fed QE or Fed QT or whatever it may be, whatever the latest acronym is. These things are absolutely critically important. And it's not just in the US market where that's important. Look at what's been going on in Japan or in China or wherever. I mean, China is basically a monetary system that operates through quantitative allocations of credit. And without that, the Chinese economy would be in a very different state than it is now. I mean, that's what's dictating the cycle in China.
Capital flows, you said something about like these capital flows are sort of netting out, across the entire world. But I mean, when we look at stuff like these institutions Michael just mentioned, the central banks, and then also all sorts of players, I mean, there is every now and then liquidity added to the system. Maybe at some point it's more done in this part of the world and then it's in that part of the world. But how do you think about this? Because this, again, then ties into my question that I really have, and I think a lot of people have when they hear this and they're rookies like me. It's like, okay, the Fed and government seem to be important in some way or form, but then how do I not only focus on these players to kind of assess the marginal liquidity, but see the entire big picture?
Yeah, I think that the whole point that all of us are trying to solve for who are modeling liquidity or spending time trying to map the sources and destinations of liquidity. I think the entire point is breaking down each agent and how exactly they're contributing or putting in or taking liquidity out of the system, and then how much that is actually attributed to the moves that are taking place. And so I think that over the last 5 years, I think especially since we had the some kind of funding market stress in SOFR during 2019, I think ever since that happened, and then we also had the bill issuance in the US in 2020, a lot more people have focused on the plumbing of the system because everyone was trying to understand. There's this kind of entire question in the 20s when you had more deflation or disinflation. how can the Fed do QE to not cause inflation, right? How does that transmission mechanism work? And then we kind of came in and we began to shift the transmission mechanism a little bit, and the plumbing became a lot more important on the short end. And then I think what has kind of taken place over the last couple of years is the plumbing is so important, but the whole question is, how does the weighting of that impact net liquidity versus, you can say, like long end rates or your FX moves and your carry trade moves and things like that, right? And so I think that the kind of entire question, I mean, an example of Japan right now and how their kind of liquidity is set up, and how you have fiscal liquidity getting added to the system, especially on the short end with bill issuance and some other things, and how that transmits into other sections of the market. And I think that'll happen until like the whole devaluation of the yen that's taking place right now shifts more and just reinforces the liquidity kind of back in the opposite direction. So I think a lot more has come down to long end rates, I think, because you have over the last, let's say, 3 or 4 years, long end rates have all just moved in lockstep as equity valuations are at highs. And people are like, oh, aren't these longer end rates moving up supposed to pull equities down because the discount rate's supposed to be higher, right? And so I think that a lot of the kind of questions are coming up is how does that valuation component work? And my view is, and I'd be really curious to hear how, Michael kind of integrates this in, is as we have entered kind of this world where we have this massive imbalance of trade with China, and we have kind of higher end rates across everything for long end rates. I think a lot of these countries are saying, okay, they're not going to revalue the yuan, or they're not doing it right now. So how can we begin to push back, whether that's pushing our own currencies down on a trade basis and a cross-border basis to bring the purchasing power parity between the countries like more into balance, so that some of these domestic imbalances resolve and they reprice. How do we do that even if we're in this rate environment that's a little bit higher? And how do we kind of rebalance some of these geopolitical aspects without kind of crashing a stock market or something like that? So I think there's a lot more push back and forth, which is it's why I think actually there's some intentionality behind pushing the yen down over the last couple of months, especially. And I think, Trump last year pushing, with the whole tariff thing and everything else, having the dollar sell off so much. I mean, he got the dollar down a lot, and I think he's going to try to do it again. I think a lot of that is trying to push back against these implications of trade with China and trying to rebalance that because they're not actively revaluing the yuan. How would you think about kind of something like that, Michael, and how would you kind of like frame that or push back on it, or how would you think about that?
I think the yen, the whole, maybe the valuation of the yen, particularly over the last few years, has been a critical example of why traditional methodologies just don't work. Because if you look at a purchasing power parity analysis, as you'd agree, the yen looks, hugely undervalued on a PPP basis. And if you look at rate differentials, particularly now, the yen should be going up, but it clearly isn't. And, I've long thought, really, I suppose probably since the beginning of 2022, that there was something more sinister, I suppose, what going on with the yen, where the yen during that period was the fastest I've ever seen a major currency devalue, in my experience. Markets just don't do that to currencies. Only governments do that. And that seemed to be a deliberate attempt. So, that by itself is an example where capital flow and government intervention, with liquidity is a really critical element. Now, on the Chinese question, I think the China question is, well, it's difficult to know where to start because there's so much that's going on. But there's clearly a constituency there that says that China has got to revalue the yuan using very much the same arguments that people would have used for the yen, with the yen being undervalued. People use the same PPP analysis and say, well, the Chinese yuan is undervalued, or look at the Chinese trade surplus. It's definitely massively undervalued. That clearly is wrong, because what China is experiencing now is significant debt deflation. And that debt deflation is not a symbol of the value currency. It's actually a symbol of a massively overvalued currency. So actually what China needs to do is to devalue the yuan. Now, the problem that China's got is there are, if you like, different exchange rates. There's an exchange rate that would equilibrate trade, which, I'd come quietly and say that probably is higher than where we are now. But that clearly is not going to happen because it would wreck the domestic economy. There's a currency rate that would basically balance the economy in terms of flow of funds, which is one which is a lot lower and probably is the correct one. And there's another exchange rate that you could envision, which is saying, well, okay, if China eliminated all its capital controls, where would the yuan end up? And that's probably lower still. So I think that the China question is one that is almost unresolvable in the sort of current policy framework. What I think is going on right now is they are trying, this is they being the Chinese, are trying as best they can to monetize debt in the economy. They're trying to get the value of the yuan down. They can't do that politically because of the dollar. So they're, if you like, artificially trying to manipulate that rate as best they can. And the end result of that is that the adjustment is being channeled through precious metals and maybe resource prices. So, in my view, maybe sort of a lot, about counterintuitive, but it's certainly contrarian, is I don't believe there's a big debasement trade going on worldwide right now. I think it's purely a specific Chinese one, but I think it still matters. And actually what you've got going on in the background is much more slowing down of global liquidity because the world real economy is hotting up quite a lot. So I'm actually very negative about markets this year, generally.
Yeah, it's interesting. How would you think about kind of this entire, the dynamic you're talking about with, you don't believe a dollar devaluation, or let's say global devaluation in currencies is taking place, but you connect it all with China. Like what is that mindset or view or kind of idea?
On the dollar, I just think that it's maybe on the wish list. I'm not going to deny that. I'm sure that Trump and his people would like a weaker dollar, but the question is, how do you get that? And that is a difficult thing to wish for in a situation where you've got a lot of uncertainty globally, where you've got, partly the fact that he's probably creating a lot of that himself, but nonetheless, you've got uncertainty. You've got a situation where I think the world economy is going to be pretty strong this year, but liquidity conditions will inevitably tighten. That may cause some instability in financial markets later on in the year. So you could get capital coming back into the US. You've got Chinese question, where the more the Chinese, monetize, the more attractive I think the dollar looks. So although it may be on the wish list, as far as I can see, all the data that we look at doesn't seem to show any significant change in the direction of capital flows into the US. Now, therefore, by default, that would suggest to me the dollar remains firm. And I fully accept that's not what is wanted from a policy standpoint, but I don't know how they get there, except by sort of trashing US front-end rates. But I don't really think the Fed's, despite what the media is promising, I don't think the Fed's on that page. So I still got that holds up, but maybe I'm wrong.
Hey guys, I'm thrilled to share my new book, The Bitcoin Enlightenment, co-authored with Mexican billionaire Ricardo Salinas. Make sure you grab your copy now and learn about how one of the richest people in all of Latin America thinks about Bitcoin. You'll find the link in the show notes.
Yeah, it's interesting because I think that, I don't read much of the news, so I'm not sure what people are saying about this, but on the front end rates, it seems to me that the forward curve right now is pricing a pretty hawkish outcome, especially after the news today, for where we're going for rates this year, right? Like I think end of last year, everyone kind of put on, I was trading at the time, but the whole trade of, betting on more cuts after Powell versus whatever that period of time is when he gets booted, right? And I think the kind of setup now is, especially with, real rates on the short end and the forward curve pricing, less than 50 bips now, right? We kind of have a setup for a pretty, like, given where we're at with everything, kind of like a hawkish or less dovish outcome price on the forward curve, which I guess for me if we have a little bit more, cuts price than what is in the forward curve right now, which seems reasonable to me, that would begin to pull down the dollar a little bit. But I think you would really need, to your point, something more from a policy perspective, whether that is kind of some type of rebalance or trade deal or something like that. So I think that will be like interesting. So would you say that you think that where we're priced for 2026, like the amount of cuts is kind of reasonable right now, or you think we'll get less cuts than what's priced in the forward curve right now?
Well, I think the economy deserves fewer cuts. I mean, that would be my view, because I think the underlying background, as far as I can see, is the U.S. economy looks pretty robust. But that's courtesy of the fact there's a whopping great fiscal deficit, and there's a lot of capex which is going on. And I think the economy is holding up pretty well, as far as I can see. I mean, evidence the GDP now estimates. So I think on that score, I would tend to believe that side of it. There's not that many rate cuts needed. Whether they actually force any political cuts, I mean, there's a moot point. I've got no idea on that one. But I'm beginning to get a lot more bullish about the long end of the bond market, for the simple reason that I think that you're going to start to see more and more financing problems this year.
Interesting. So you think we won't price more cuts on the short end, but you think bonds will rally on the long end and the curve will flatten?
Yeah, I think you're going to. Everything I look at tells me you're getting a flattening coming through.
You think we're going to have flattening, but then growth is going to remain strong, or growth is going to decelerate?
No, I think growth continues pretty much where we are. But I think that the inflation numbers, in my view, I think inflation technically remains restrained. I think that the curve will begin to flatten. And although that may seem counterintuitive, I mean, that tends to be the case anyway into recoveries. I mean, the yield curve is forward looking. And it wouldn't be a great surprise if you've got a flattening through this period. That would suggest that you get a slower economy 1 year out, perhaps. But I still think that would be my bet. Everyone is betting the opposite way. I mean, I fully understand that. And it's not being for want of being a contrarian, but it's more the fact that I think that from what we see, you're looking at liquidity conditions beginning to tighten, with the exception being China, which is on a very different cyclical path. I think you're going to get a stronger economy, as I said, but a flattening curve. And everything I see when I look at bond markets right now, despite the fact that there's this widespread discussion about term premium continuing to move upwards, et cetera, I just don't see it. There's no evidence of that at all in any of the data, looking at daily estimates of term premium across the world, with probably maybe the exception, but it's not even there. It's not compelling, of Japan and France. But you're looking at a remarkable stability in bond markets, given the backdrop of this constant drumbeat of debasement trades and debt monetization. Now, I'm not saying that's not going to happen in the long term, but I don't think it's necessarily the main agenda this year.
I see. Yeah. I mean, I want to come back to Japan once again, real quick, because like you guys both hinted at it, but like, what can we expect from Japan this year, And then also, like, how does it differ? We already talked about this a little, but how does it differ to China when it comes to its connection to the global risk curve? Because you mentioned it, Michael, there's a capital account which is closed kind of in China. Japan, it's not the case. And then, but also Japan is very well known for having built up this huge savings pool of people who have a lot of savings. Is that the same with China? Maybe you guys can help me understand this again, and then also how it connects to this year, what we kind of can expect from these two bigger economies. Maybe Capital Flows, or you want to?
Yeah, I think in terms of like a broad view on liquidity and then connecting to Japan, I think we're at an elevated level of liquidity. I mean, I think equity valuations and where we're at with stuff like that is showing that. I don't really believe that we're in a contraction in liquidity, just because I think that when you have low quality names on the far end of the risk curve in banks, financials, in Japan, the US, when you have this kind of same thing taking place in the Eurozone, just, historically, when we look at liquidity like beginning to slow or contract, or even just kind of like normalize, usually like there is always some type of risk asset on the far end of the risk curve that gets hit. And I'm not really seeing that yet, which is why I think that I probably have less of a contraction of liquidity view than Michael. Maybe he's just better at forecasting like the front end of that than I am. But I think that I'm not really bearish risk assets yet, but I think that there is some type of fragility building just with where we're at on like where would the next upside liquidity impulse come from, which is why I kind of think like, okay, well, that's why this kind of dynamic with Japan and the cuts on the forward curve matter. Because I think if you have more cuts take place, we're pricing 45 bips for this year take place. If we have more cuts take place, and I kind of agree on the inflation kind of remaining contained. If we have real rates on the short end come down, and then we have Japan continue on their fiscal side, where basically every downward movement we've had in the yen has just pushed up Nikkei valuations, and it's also helped push up equity valuations in the US, right? It's been one of the contributing factors for liquidity in the US. I think if we have those two things happen, that's why we're actually seeing capital bid like all the highest risk Japanese banks, a lot of I think that's why we're seeing the Russell up right now. I think that's why we're seeing a lot of the names and valuation expansion across of those. And so that would be kind of my view. And I think the reason why we're having a divergence where rate differentials in Japan are not explaining the movement down in the yen, to kind of Michael's point, is mainly because of you have the shift in the fiscal side, and you have a lot more fiscal spending. We have one of the biggest deficits in Japan that we've had in like decades, right? And all of that is being funded by bill issuance, right? So JGB yields on the long end have just been going through the roof because the Bank of Japan is rolling off their balance sheets. And the whole question is, well, if rates are going up, why isn't that and inflation is high, why isn't that pulling down the Nikkei? And I think that the only explanatory factor that would net out make sense is the fact that you're having this entire fiscal spending and bill issuance, which even connects to the price action, because every single time you've had these fiscal releases about either bills in Japan or with the fiscal spending side and any news around the politics side, it's caused a bid in the Nikkei and a sell-off in the yen, like every single time consistently. The kind of question is like, how much longer is that going to push liquidity into the system, right? And I think that's kind of what the question kind of sets up to be as we're moving into Q1.
Yeah, I mean, I think that could be, I kind of buy that argument that I think the backdrop is probably quite bullish for Japan. I think if you look at if you sort of cut through the noise of a lot of people that are saying, okay, rising yields in Japan is going to be the factor that ends the party because it's going to disrupt the yen carry trade. Well, I've been around long enough to know the yen carry trade when it was big, and I'm not convinced it's that big now. I mean, it may have an effect. I'm sort of equivocal on that one. But if you look at the term premium in Japan on the bond market, and you look at the ultra long end of that, what you find is that that's where you've got a very significant spike in yields, and in fact in term premium. And that's telling you much more about the switch of Japanese domestic investors out of fixed income into equity than is a loss of confidence in Japanese bonds overall. So I think that what you're seeing in Japan is very much an equity, a switch into equities from bonds rather than a dumping of bonds per se. And I think that's an important difference. And that may go a long way to explain or be consistent with your point that whenever the yen weakens, the Nikkei goes up, which I think is right.
Yeah, so I think the point that I would make, where I would go just a little bit further than that, is that if we are just seeing a rotation, like let's just say domestically in Japan, from JGBs into Japanese equities, we probably wouldn't have seen such a large commensurate move in the currency at the same time. And so I think that's why we are actually having like liquidity in Japan seep out into, gold. I think, part of the dynamic in gold and silver is Japan on the capital side, and then, China on their trying to rebalance side. But I think that I think it's also people recognizing that they want to also have capital and liquidity flow out of Japan into the US on a marginal basis. which is why the yen has been weaker, and it's had that correlation it's had to kind of reflect that it's not just from JGBs into the Nikkei.
I mean, in terms of Japan, one question that I would have as well, maybe to you, Capital Flows, is, I mean, we know that we have heard this from the central bank itself, that they want to take a back seat when it comes to some of the government bonds that they've been holding, and maybe offload something to the private markets. Is that relevant at all? And if so, wouldn't that mean that some of the private people will have to, or private investors will have to step in, and that could then kind of drag down some of the liquidity and for equity valuations?
Well, yeah,
or how do you think about this?
Yeah, to Michael's point, like, you know, rates going up is not going to unwind the carry trade necessarily. I think the reason why that is because, you know, real interest rates on the short end in Japan are negative right now. So they're still accommodative, and only over the last 2 months have real rates, 10-year real rates in Japan moved positive. And as that's happened, you've actually seen 10s, 30s in Japan begin to flatten a little bit to kind of show a little bit of a marginal shift in liquidity as 10-year real JGBs turn positive. So I think like that's part of it, but I think on the kind of on the yen side, or on the BOJ side, I think that they're rolling off their balance sheet. So if you look at JGB holdings for, you know, the Bank of Japan, it's all decreasing right now. They're not doing, you know, outright quantitative tightening, but they're letting things roll off their balance sheet. That's one of the drivers up, along with inflation. And institutions are beginning to rebalance on a percentage basis the market to hold those. But I think that if they want to, the Bank of Japan, I think it's kind of taken a back seat a little bit because their actions in yield curve control during 2022 is what pushed the yen down so much. And now they're taking more of a less aggressive stance in terms of pushing on markets, right? They had their intervention here and there, but they're not the main driver of the yen now. And the fact that you have rate differentials not explaining that is kind of why the fiscal side is now the main driver of the market over the last 6 months, which is why like all the BOJ meetings we've had, they haven't moved the market at all, right? Any of the pricing in the forward curve, like they're not trying to change anything or shock it, the forward curve with forward guidance to really shift it. And they've let the fiscal side push the market more instead of trying to push back against it, which kind of goes back to like my view of like, I think they're trying to push the yen down because China's their biggest trading partner and they need to kind of shift the kind of trade balance that they have between China and Japan right now. And I think that's why,
Yeah, it's make Japan great again.
yeah. I mean, I think they're trying. I think it's at the expense of higher equity valuations, which will eventually like begin to, I think that as soon as you have peak bill issuance and fiscal spending, and that all gets priced, especially the bill issuance, and that stops, then you're going to have a lot of issues because debt to GDP in Japan right now, or excuse me, market cap to GDP in Japan right now is basically at the same spot we had it in at the 80s bubble that we had. Right. So like, I think that's a huge issue, right? Because you have this massive imbalance in terms of equity valuations, and you have Japan, as their currency is going down, the main thing that's pushing inflation up is all of their imports. And so their weaker currency is pulling in higher prices, which is fundamentally like you have higher prices and higher inflation swaps in Japan. At the same time, you have equity valuations at these levels that we haven't seen in kind of long time. So I think that will be, it's a source of liquidity right now, but I think it's going to be a massive source of risk. It kind of just depends on how they want to prioritize liquidity in markets versus any geopolitical risk with China. That's how I kind of think about that relationship.
So, Michael, I would be curious because Capital Flows mentioned this before, and it is this, if you look at markets, we see some of the like riskiest assets, indices, like really the shadiest assets being at all-time highs, How do you square this with your view of liquidity, which is actually contracting? Like, shouldn't this be the other way around, or how do you square the circle here?
Well, if we come back and discuss this in 6 months' time, we'll see if it's true, because liquidity is a leading indicator. You would expect, and by the way, it's only just inflected downwards, and it's only really inflected downwards in the US. There's some evidence in the Eurozone that's beginning to peak out, but these are growth rates, bear in mind. I'm talking about not absolute levels. So you're looking at a loss of momentum in the cycle, which is the critical element we look at. So we're early days, but I think it's happening. And in order to do well in investments, you've got to look at least 6 to 9 months ahead. And that's pretty what we're trying to do with the signals that we use. Now, I'd also say that if you go back and turn the clock backwards, and you look, for example, at the period when this bull market started in late 2022, you'd have to say that over that period, economics per se, in other words, looking at the business cycle, has been absolutely no use at all, because economies are broadly flatlined. And, consequently, economists have been talking about the next recession or whatever it may be. And I think had you listened to economists over this period, you'd have lost a lot of money. In terms of what has driven markets, it's very clearly been a liquidity stroke capital flow. It's been a very, very normal cycle in that regard. And if you look at how the market has evolved, both through assets and in terms of industry groups, it's been a sort of a classic market. In terms of assets, you began with high yield credits and equities. You've migrated through equity sectors, beginning with technology. You've started to see things like financials performing well mid-cycle. You've had resource stocks, coming through late in the cycle. Commodities, clearly as an asset class, have been sort of gangbuster in the last 12 months. Gold, led the gold, but also things like copper. Oil is hasn't really moved, but that's really a commodity increasingly. And then you've had the shift from large cap to small and mid cap. And all these features are sort of normal evolution of an investment cycle. So it's been absolutely like clockwork. So all I would say is that you're looking now at all the wonderful, indicators out there, the outperformance of junk stocks, the outperformance of small cap, the fact that resource stocks and energy are beginning to run towards a late cycle sign, the fact that technology is losing momentum, again, another feature. So everything you're going to see is, I think we're looking at a very normal evolution of a cycle. Therefore, you've got to start thinking about what's going to happen in the downswing. And that would suggest you want to be picking up now defensive groups. Maybe it's a tad early, but you put a toe in the water, maybe moving towards linking your direct. As I say, that's a completely contrarian view in many cases, because people are still very gung-ho about how this bull market's going to keep going. But then after all, they always are. And then the point is that bull markets are all about themes, whereas bear markets are about cycles. And the cycle skewers you in the end.
I just wanted to add something. I think that like on the liquidity view, I don't think that Michael and I are that far off in a sense. I think it's more about like, there's stuff that we don't know in the future. And then we have the ways that we are kind of modeling liquidity on the specific time horizon we're operating on. Right. So I'm sure that like, if we walk through like liquidity and like, oh, we have these markets and these markets and these, like there's, at the end of the day, if liquidity shifts, the trade-off will be either way, right? If liquidity shifts and it contracts a lot more, kind of like what Michael is saying, then like I'll begin to get, take off exposure and get stopped out of positions. And then if the opposite takes place, right? And if we continue to rally and then we, roll over later, then, I would have some upside or something like that. And I think it's more about the trade-off between the time horizon, not as much like, well, like who's right or wrong here? Because I do think I would agree that there are some risks in liquidity right now that are like building, but I just have not had them begin to impact like the specific strategies and like equity risk I'm running. But I do think that it's a very like valid point in terms of like where we are in kind of the cycle. So that's kind of that's how I would approach it, at least.
Yeah, no, makes a ton of sense. I mean, you had this piece, Michael, just a couple of weeks ago also, where I think you were saying in the title as well, like I'm buying Bitcoin on weakness, and I discussed this with a couple of friends of mine as well. They're also, Howell Capital Flows, I think from what I gathered, you also put on a Bitcoin trade just recently, given that we've seen some strength there. Can you guys help me think this through? what's Bitcoin doing currently, and yeah, how does it fit into this bigger framework of like there are these liquidity risks lurking. We cannot look into the future, so we don't know what's actually coming. But help me think about this as well. Maybe Michael, what did you argue in this piece that you wrote?
Well, I think the first thing to say is that we did maybe a couple of years ago, an analysis which was a statistical exercise using what was a vector auto regression model framework to try and understand what were these systematic influences on Bitcoin. And we found that there were, broadly speaking, 3 or 4 main factors, of which liquidity, global liquidity, was the key one. That was about 45% of all systematic influences. Then you had what we would call investor risk appetite or investor sentiment, which you could argue is something like a NASDAQ factor, maybe. So if NASDAQ is strong, you'd expect there would be some spillover into Bitcoin. And then the remainder part, which was about 20%, about 25%, was other precious metals, particularly gold. And gold had a very interesting relationship between Bitcoin because it was very positively correlated in the long term, but it was very negatively correlated in the short term. So if the gold price spiked, you would tend to find spiked upwards, Bitcoin would be weak, and vice versa. And that may be because they're switching between the two. People tend to jump on one bandwagon or the other. But generally speaking, they were moving together, they were trending together. They cycle apart, but trend together. Liquidity is clearly the dominant factor. And that we showed that had a lead time of about 3 months. So the corollary to all that is that Bitcoin is probably the most sensitive asset on the planet to liquidity. It tends to show up very quickly in Bitcoin. And our view is that over the long term, Pancho, what I just said about there being a cyclical downturn this year, but in our view, liquidity is rising in the long term simply because debt is rising. There's no way we can get out of our debts. It's compounding in the future. And in order to roll over debt or service debt and roll debt over, you've got to have liquidity. You've got to have balance sheet. So liquidity is going up, which means that a main driver of Bitcoin is trending higher. And on the basis that Bitcoin holds its integrity as an asset, then you've got to own Bitcoin. Now, can I time Bitcoin precisely? No, I can't. But, with most assets, if I think there is value there, I'd be more than happy to buy it 1 standard deviation below its normal trend. And that's pretty much what I was saying. And we got down to those sort of levels when it was down at about 80,000. And it's now perking up a little bit. Am I bullish for Bitcoin this year? Not particularly. But I'm certainly bullish on a medium-term view, yeah.
What is your view, Capital Flows? Because I feel like you've put on this trade as well. And you were pointing to this very connection of Bitcoin's price to real interest rates, right? And I was running this correlation just recently as well. And I think in this period that we were looking at ever since October, it was a very strong negative correlation of what I found was like minus 0.77, which is a strong negative correlation to me. So yeah, maybe you can flesh this out and also help me understand, like, how is Bitcoin connected to real interest rates in the first place? Like, is it just because like real interest rates going lower is sort of a good risk on environment, or is there a more tangible way to connect Bitcoin to the real interest rate network environment?
Well, yeah, I think that when I kind of map out the Bitcoin model that I have, I think it's similar in the sense that like any of us who are kind of like building liquidity models is, all we're doing is breaking down, hey, what are the sources of liquidity? Let's run rolling PCA regression, whatever it is, against it, and do that in real time, and then begin to decompose our view of price and like some quantitative signals and connect them with whatever the attribution is, right? So you say like, oh, like if there's a certain relationship that exists between Bitcoin and rates right now or Bitcoin and FX, and do I have some view about the liquidity source of that? Let me run a regression between it and begin to say, this is going to have a positive or negative impulse. And you just basically break down all that, have a correct attribution, and you want to have like a clear kind of understanding of like, all right, the factor model that I have, or the liquidity model I have, or whatever you want to call it, is, it explains the majority of the moves in price action, right? And so I think that on the liquidity side, I think, real rates in the US, I mean, if I think about my Bitcoin model, It takes real rates and weights them across like every single major country, looks at the quantity of money in the system, maps how that's connected to FX transmission, and then it maps how Bitcoin functions on the equity and factor risk curve across G10, right? So you want to say, like, for example, like Bitcoin, like I think liquidity has been expanding for a while, like all last year, like liquidity was expanding, especially in the second half of the year. And we saw that capital, that liquidity expanded, but it went to different destinations. It didn't go to Bitcoin, but liquidity was still expanding. If you look at just, I mean, very simple, like if the biotech ETF or, financials or whatever they are rallying, like that's not happening. All those things at the far end of the risk curve are not happening when liquidity is contracting, right? So that's why I think Bitcoin is not a sole barometer of liquidity expanding or contracting, right? Which is why, like, I'll say, okay, if I think I have this like attribution model of like these drivers in Bitcoin, and then I say, okay, where's all of that liquidity going? Oh, it's going to these things on the far end of the risk curve. Then I would look, okay, when is Bitcoin beginning to outperform these different other assets on the far end of the risk curve on a vol adjusted basis, so that I can say like, okay, now the destination is shifting from some of these names to like Bitcoin itself, right? And the destination has changed, even if the source of liquidity has remained constant, right? And that's where you have like rotations. So what I would say is like to kind of pull all that together, my view is that liquidity right now from on the Japanese side, and then I think that I probably have a little bit of the opposite view of Michael in terms of like how cuts would get priced on the forward curve, because I think it'd be very challenging to have growth remain constant and the curve flatten. That'd be difficult for me to see like a historical analogy where like that kind of like happens in my view. I think we'll have more of like a Goldilocks, right? Where you have inflation risk come down a little bit more. I think we can hit 2% inflation. And I think that if you have short end real rates drop a little bit, as you still have this impulse on the Japanese side, you basically kind of have a setup for some capital to rotate, as well as for Bitcoin to rally off these lows, which is kind of like happened. So I'm long Bitcoin right now. And if we begin to see those kind of like factors shift, I'd begin to like shift my view. But I'm not like outright bearish or super conservative risk assets this year yet. That would kind of be more of a path dependent thing. I'd kind of like see how it kind of plays out in real time for kind of like my views.
Yeah, Michael, because I was talking to some other people who were seeing this similar dynamics, and they also told me that the Goldilocks scenario could very well be on the table. Do you see any possibility for this? And what would make you think that this could be the case? And you had to kind of reassess your view. Let's now like pigeonhole it like this. But yeah, how would you think about this?
Well, what would cause me to rethink if there was
sort of, yeah. Or do you see this scenario for a Goldilocks? Yeah.
Yeah. Well, I think that in terms of we can run through the factors. I mean, one is that are the central banks likely to be more accommodative or less in the next 12 months? I would say probably marginally less. Overall, I mean, I'm certainly not saying there's going to be a significant tightening. I can't see that on the cards right now. So that's point number one. Point number two is, are you going to see any significant expansion in terms of private sector balance sheets? And I think the answer in terms of credit I'm talking about, I think the answer to that is yes. But where is that going to be funneled? It's going to be funneled much more into the real economy. So I'm very upbeat on the real economy. So, it's gratifying to see further evidence of the US economy on upswing, because I think that's what's going on. But, strong economies don't always have strong financial markets. And the question is, if you look at the positioning of investors right now, they're pretty fully invested in risk assets generally. And so the question is, if you've got limited liquidity expansion in terms of financial money going into financial markets from Fed or from the private banks, and you've got investors that are pretty full up with risk assets already, where's the marginal buying going to come from? And that's really the question that I shrug my shoulder at. I don't know. I may be wrong, but it's going to be one of those factors. Either you get a blow off in terms of risk appetite, or you get liquidity seeping back into financial markets.
Yeah, I think that, to your point, like this kind of idea of, are central banks going to be more or less accommodative over the next 12 months? I think it kind of depends in terms of how much is priced, because I think we just had like stir rates in the Eurozone, UK, Australia, US, like every kind of like major stir contract, like in the last year, basically blow out and almost price hikes. So I think, like, to your point, like, are central banks going to be more accommodative? I don't think they're going to be necessarily more accommodative relative to the amount of cuts they did last year, but relative to what's priced right now, I think that they can be more accommodative relative to what's priced. So, like, that's kind of, I guess, the way that I approach it, because I don't know if, like, the net amount of cuts this year relative to last year could be whatever. But I think that relative to, especially in some of these other countries, like, how much, like a broad basis, how much will that be? And I think that's why I'm still see Japan. I think they're a positive liquidity impulse. I think Eurozone, especially with their equity markets right now, I think the fact that they're blowing off and you still don't have a ton of cuts priced is an indication we're still pretty loose. So I guess that's kind of how I view it in terms of like how much is priced versus realized. That's why I lean a little bit more toward the Goldilocks as opposed to contraction.
So you price more cuts into the US curve and more into the Japanese curve?
Not Japanese. I don't think it would be the Japanese curve, because they're doing hikes right now. It's more about how many hikes.
Yeah, that's
Japan
fine.
had.
Yeah.
Yeah, so I know, but on the Eurozone curve right now, right, like they just blew out to a lot less cuts in the Euribor 6 and 7 contracts. Same with the UK, same with Australia, long end rates. They all kind of like blew out to the positive growth kind of scenario. And I would find it difficult to see those blow out again and create negative liquidity impulse to the upside. And then I would also see it very difficult to say, well, we're going to have positive growth, but then we're going to have flattening in the curve, which is like, I think the opposite usually happens, right? If we're going to have like the long end rally, as you know, we have a neutral central bank. If the long end is rallying, then growth is probably falling in the economy as opposed to expanding.
Well, I know it should, but if my instinct is correct, or memory is correct, I think you may find that it's often the case that at the peak in the curve is normally about the trough of the economy. So you tend to find, but I'm more than happy to be proved wrong, that the curve tends to flatten as the economy begins to recover.
It would be more about like if it's bull or bear flattening, right? So I guess
Yeah. I would be equivocal about that. Although I do think you may be getting, I'm probably leaning more towards a bullish flattening, but that.
Yeah,
probably,
well, I guess if I see bull flattening in like the curve, then that would tell me that the Fed is being overly restrictive and you have growth in the economy contracting more and the Fed is falling behind the curve. And so the long end is pricing what the Fed isn't doing, which means that growth in the economy is likely falling. So that's why I would, if we have a flattening curve where the Fed it would depend on like what type of flattening is taking place. But if the view is that they're not going to price more cuts, then it would be a bull flattening view. That's why I would not really see that as like a very high probability. If like the Fed is neutral, if they're not doing anything, and then you have the long end rallying and the curve flattening, well, if that's happening, like historically, that's always when growth is contracting and the Fed is falling behind. So if that the end took place, then I would definitely agree that like risk assets would probably begin to have some issues. So, but I would view more of like a Goldilocks regime. And because of that's why I actually like this year holding stocks and bonds, because we could have kind of like a 2019 year where we have inflation move back down closer to 2%, stocks and bonds rally together, and then the kind of biggest rallies in duration maybe occur in some pullbacks in S&P, but on net they end the year higher. So I think it'd be an interesting year. I think that'd be very interesting to see how it kind of plays out.
So where would you position on Wall Street? Would you be looking at the names that have been running? The resources, energy, maybe a little bit of financial still, or would you be thinking about moving more towards defensive?
I wouldn't really put as much like allocation toward the defensive side yet. I think that it really kind of comes down to how exactly that this rotation plays out. Because I think that the fact that the Russell has just had up day after up day, right? And then Mag 7 is underperforming a little, that rotation, it's very challenging, like just for the microstructure of the market for that to change, right? Like for passive flows and for all these other like positioning metrics, right? So I think that if like broadly speaking, I think that until we begin to see all of those names on the far end of the risk curve begin to underperform, then I don't want to get into defensives. So I would look for, like, I don't think that, like, in my view, I wouldn't justify like getting overweight defensives and like a low vol factor or like a high dividend factor or something like that, or a value factor, until we begin to see the like cyclical names or small caps and micros and all the low quality names begin to underperform. So I think like the fact that we have Mag 7 underperforming right now is because you actually have some capital moving into like non-profitable tech and some other things, which are not really, I would say, characteristic of like liquidity contracting yet. But I think the entire point is that we're at really high valuations across everything, and it wouldn't take like a massive shift in like a geopolitical thing or like a delinquency source or something like that to really begin to unwind things a bit more, just given how high we are in valuations overall.
Well, guys, thanks a lot for doing this. I mean, I don't know if you guys want to continue, but for me, I got a lot of points to ruminate on. I guess it's the same for the people who have been listening to this. I don't want to take too much time.
No, it was great. It was such a blast to be able to chat with you, Mike.
Yeah, likewise. Enjoyed
Thanks,
it.
guys.
Keep waving the flag.
Thanks for the time.
I love it.